Bill, how would you recommend that people read How to Make Money in Stocks? It sounds kind of silly, but do you think they should just read the whole thing straight through first, or should they take it chapter by chapter and make sure they understand? What would you suggest?
Well, you can do it two ways. You can go chapter by chapter and go through the whole book. You mentioned to me that there were a couple of people that did very well that took one chapter at a time and read it over and over until they got every last thing in it. I'd not heard that before, but it's probably not too bad of an idea. The one thing I do know about the book, because we've been out there for a number of years with it, and we've given hundreds and hundreds of workshops, and we have a lot of people coming up in the workshops, and what I found out is that the ones that come back to 3, 4, 5, 6, 7, that they'll bring the book up. And it's dog-eared, and you've seen they've read it over and over again, and they've got notes in it. I've had people tell me I read it once a month. I've had people tell me I review it every year. You just wouldn't believe how many times they keep going back to it and back to it. And I think it's because we've got so many rules that they want to make sure that they really understand the rules and they've got it down. So it's like anything else. Learning is a question of repetition, and you are not going to get this by reading it one time. Now, you sure aren't going to get it if you get the book and set it on the shelf and you don't read it, or you glance at it. Don't kid yourself. You might as well put your money in the savings and loan or something. You have to go through and read it and make notes. And I would say at a minimum you got to read it twice, because you aren't going to get everything, because a lot of it's very different than what you're told or what you've believed. I met a woman a number of years ago that told me that she lived in Eastern Europe, and that she was around 23 when she realized, and this was after the Cold War ended, that every single thing she'd been told in school was wrong. In other words, they had brainwashed her, and so she had to start all over again. And I think that there's a little similarity here in that a lot of people have beliefs about the market. Oh, I'm a long-term investor, or I want dividends, or oh, I want to buy a reasonable PE, or I don't think charts work, or go on and on and on. There's so much ignorance about how the market actually works. It's no wonder that people have trouble and struggle. There is no reason for somebody to lose 30, 40, 50% in the market in a bear market, because the market tells you when the market is topping. And you have to read it and see it and start backing away and say, I'd better raise some cash. One thing I did in this book that I think is quite interesting, somebody should look at, is we took 5 or 6 of these high-profile catastrophes. General Motors. Incidentally, General Motors had been relatively underperforming the market for the last 31 years. A relative strength line on the chart shows you that. So anybody that was buying it because it was General Motors and it was, a blue chip and something everybody could own and have a dividend or whatever, wasn't looking at the facts. We showed the top of General Motors, and we've annotated all these charts. We showed 15 specific times when it was getting heavy selling along the top, before it rolled over from the high 50s and we went to $2 or whatever it went to. We did the same thing with AIG, the insurance company that used to be held by all the institutional investors, one of the biggest worldwide insurance companies. We did the same thing with Citicorp. We found, but on each one of these stocks, there were between 13 and 17 specific days where you had heavy distribution in along the top. Now, anybody that learns how to read a chart can see this isn't acting right, this isn't acting right. It's going over and over and over again, and it's lagging the market. Something's going wrong. You don't have to just sit there and say, oh, well, it's Citicorp, and it's such a great company, and it's a bank, and, banks are good. There's no safe investment out there. Anything can have a problem, and you have to realize when it's beginning to have the problem. Now, you go to the grocery store and you go in the vegetable section and you're picking up some tomatoes and you maybe get some potatoes and a few other things. Well, you recognize a potato that's getting a little rotten, or that is spoiled or has some big soft spots in it, and you don't pick up that potato. And it's the same thing with stocks. Maybe Citicorp was very good for a certain 5-year period, and all of a sudden the management changes. They make too many mergers. They get into something that's dumb and stupid. They're doing things that are wrong, leveraging too much, like 30-to-1 leverage or 50-to-1 leverage in bad loans. And all of a sudden you got a $2 stock on your hands. Well, it doesn't go from 55 to 2 by accident. It's showing you all along the line something's going wrong, something's going wrong, something's going wrong. And if you're just sitting there listening to somebody else's advice and you're not looking at a chart that tells you this stock is getting heavy volume of liquidation, then you shouldn't even be in the investment business.